The information and opinions presented in this Arc Energy Ideas podcast are provided for informational purposes only and are subject to the disclaimer link in the show notes.
This is the Arc Energy Ideas podcast with Peter Tertzakian and Jackie Forrest, exploring trends that influence the energy business.
Welcome to the Arc Energy Ideas podcast. I'm Jackie Forrest.
And I'm Peter Tertzakian. Welcome back and happy 2023. Jackie, how were your holidays?
Oh, very relaxing. We were really in an island of calm and mild weather here in North America.
Yeah.
Everywhere else, it seemed to be crazy. So I was happy to be home and we had that warm weather. So it was great to get outside and did some skiing and cross-country skiing. And
it was really great. And I think you, like us, were among those who did not travel and experience some of that chaos, certainly the pre-Christmas chaos with the travel snarls, cancellations, and so on. So we typically don't travel during Christmas because it is chaotic.
Yeah.
Even with good weather, it's often chaotic.
Yeah, and this year it was extremely. So hopefully, I know some people are still trying to get back from their holiday break. So hopefully people are mostly back now and ready to go for 2023. And we are going to do something which, is a little dangerous this year, I think, is try to predict some themes. And I say it's dangerous because really a lot of uncertainty, I think, as we look out over the next year in terms of how things will unfold.
There are so many themes and so many themes that will probably emerge that we'll miss. But some things I think we can say there's clarity on. And so why don't we get started? I think the first theme, which is a near-term theme, is the impact of the China zero COVID policy relaxation. The consequences of that, which we're starting to see. Well, I'm not sure we're starting to see. I mean, there's not a lot of transparency coming out of China, but no doubt this will have a huge impact on the economy, potentially either way. If the relaxation goes well, then the economy starts to rev up, but there is the chance that that pandemic in China gets worse, and that has the potential to slow things down, at least temporarily.
It's still just evolving, but I mean, the concerns are that because this virus is moving so quickly, it risks new variants. And, worst case scenario could have impacts beyond the border of China.
Right.
I know some of the countries, including Canada, are putting some restrictions on now, concerned by that.
Right.
But that might also slow just generally the recovery of the Chinese economy. So what do you think is going to happen here, Peter?
I think that there's going to be volatility in the near term as headlines about what's going on in China ebb and flow with respect to the pandemic, but by mid-year, I think it'll be all over and that the demand side of the equation is going to be stronger and the pull is going to be stronger on energy commodities.
Yeah, no, I'd agree with you. I think expect lots of bumpiness and unexpected twists and turns in the first half of the year and the second half stronger. This had to happen eventually. You could argue it could have been done in a more organized way, maybe with more vaccinations in China and in a less disruptive way. But eventually, the Chinese economy had to open up. It's like the second largest economy in the world. And in the end of the day, that is going to be positive for commodities at some point.
Well, it's easy to be an armchair critic of how it should have been done with 1.4 billion people. But it's not easy. Anyway, it is what it is. But let's move on to the next theme.
Okay, another one that's hard to predict, Ukraine war outlook. And believe it or not, February of 2022 is when it started, so coming up to almost a year. And the ending does not seem obvious. It seems like the Ukraine does not want to give up any land and Russia does not want to lose. So how do you think this is going to play out and what do you think it means for energy?
Well, I think the situation is going to get more tense yet. I mean, even as we record this podcast today, the Western alliance is pledging even more military equipment to the Ukrainians in the form of armored vehicles and air defense. And so there's this gradual ratcheting up between East and West. And as we said in many of our podcasts, we are in a proxy war. We can't be naive to that. This is going to probably escalate into the spring when typically wars start to come out of their winter hibernation and get... So I think you're going to see more tension that comes out of this, which will lead to more volatility in the markets, including the energy markets.
Right. Yeah. I mean, if you assume a scenario that Ukraine continues to have support from the US and all those weapons, and Putin continues to have support from the Russian people, then I could see this being a feature of 2023 and the energy war as well as the real war continue to be a part of what we have to deal with this year.
Okay. So moving on to theme 3, which is unavoidable inflation. So inflation was a dominant headline in 22 as a consequence of supply chain constraints following the pandemic and also the supply tightness of energy commodities as a consequence of the Ukrainian war. So inflation was a big deal. We saw the US CPI, Consumer Price Index, all categories rise. In November of 22, it was 7.1%. It actually peaked last year at 9.1%, which is still way far higher than the 2% target of most Western central banks. So, what do you think?
Oh, I would add, as we're recording this, there's been news that over in Europe, it's also starting to come down. It peaked at 10.1%, and it's down to 9.2%. So this is still very high, although it's better than it has been. It's going in the right direction. And I think most of the federal banks have signaled that they're not done with the interest rate increases yet. So I think we're going to continue to see this be a very important policy for central bankers to increase interest rates, maybe not as much as we saw last year, but they're probably not done yet.
Well, recognizing that the world's economy needs energy. Energy is the fundamental driver of costs because so much of the things that we consume need mobility, need energy to produce food, etc. That energy costs are the thing to watch. And also an understanding that the way inflation is reported month over same month. So the January number for this year will be measured over the January month of last year. And then the percentage is calculated February over February, March over March. As we progress into the year, things will sort of flatten out because energy prices peaked, I think it was early summer.
More in the summer, yeah.
Early summer. So by the time we get into summer, you're going to probably start to see inflation numbers that have actually moderated substantially because it's flat over flat. I mean, notwithstanding if we have another oil price spike or something like that by summer. But in the absence of that, I think you're going to see those numbers start to ease and you're going to start to see moderation in interest rate hikes and things like that.
Yeah, I hope so. I will add, the China opening, that may help inflation because some of the issue with the supply chain last year has been because China kept shutting down plants and things like that. And so that's another factor. I think we're going to go through some ups and downs here with China, but by the end of the year, hopefully some of those supply chain issues will look a lot better. And that will be positive to solving some of the inflation issues as well.
Okay, well, let's talk about those commodity prices and our outlook. So that would be theme number 4. What do you think?
Well, last year, commodity prices for oil had a real round trip, right? Started at $70, peaked above $120 near the summer, and are in the mid-70s as we speak. And it's been a very volatile start to the year, actually. Oil prices have really come down at the beginning of the year. And gas, too. Have you watched what's happened to gas at the beginning of the year? So we had gas prices in the summer at about $9 in North America at Henry Hub, and they're now under $4. So major slide for gas as well. So, I'll start maybe with my position. I think oil's a tough one to call. I mean, there's a wide set of events here that could occur. If Chinese demand comes back roaring here and Russia's supply is cut back significantly because of these sanctions, I think we could have quite high prices. On the other hand, if there's recession and slow economic growth and China doesn't rebound very quickly and we don't really lose a lot of Russian supply, prices could be, where they are here or even lower potentially. So it's really uncertain in terms of what the probability of each of those cases are, but I think each of them is possible.
On balance, I would say the bias actually is probably a little bit more pressure on the natural gas price. As I said, we're coming out of a mild winter, I think, this year, and more production coming out of North America, probably in excess of the ability to export into the global markets. So probably the gas side is going to be weaker than the oil side this year, which is a flip from 2022.
Yeah, especially in North America. I mean, I think anything can happen over there in Europe. But I think in North America, we had obviously a very cool December, especially around Christmas. But the outlook right now is for a very warm winter. And if that actually comes to be, we're going to have excess storage. And we also got a bit higher production than people were anticipating. So I think we're setting ourselves up potentially for a weaker gas market this year in North America.
Right. Okay. So as if we didn't have enough variables to think about, it moves into our 5th theme, which is the year of the electric vehicle pickup truck. and the adoption of electric vehicles continues, the opening up of more or the expansion of more models. I mean, I don't know, there's probably 20 or 30 new models coming in, but several of those models are pickup trucks, which of course are the favorite of a certain segment of the population, a large segment of the population. And so as we have the Ford Lightning, the GM equivalents in the Chevy Silverado, and other models coming online, even Ram, I think it was a few days ago, announced their electric vehicle at the CES show in Las Vegas. Looked like a pretty slick vehicle. I don't know when the Tesla pickup truck's coming, but whatever it is, this, I think, is going to be the year where the adoption of electric vehicle pickup trucks is going to emerge. Now, I also think it's going to be a bit of a test to see if people buy them.
Well, and there's long queues for them, but it doesn't cost you very much to put your name in the queue. So it's still a little uncertain how many people will buy them, especially, as people are under more pressure with the higher costs of everything right now. I think there's a big part of the truck market that these don't really meet the utility of what they're looking for. I think that's one question I have. I know towing is a big issue for these trucks. I actually looked at a blog about this, but a Tesla Y owner was pulling like a 2,000-pound camping trailer and reported that they lost 50 to 60% of their range.
Oh, yeah.
So some of these trucks will be able to haul things, but the range is going to be pretty short. And then if you do it in winter, you're probably at like a quarter of your range. So for those that want to haul, unless it's short distances, always coming back to your home to charge,
Right.
I think it's going to be a bit problematic. And then, there's just not a lot of infrastructure if you want to take these on the road, especially in Western Canada. So I think that'll be an issue here. But on the other side, there's some real advantages. Ability to plug in your electric tools, keep your cab warm when you want to get a break from the cold. I think that's something people don't appreciate with the electric vehicles. You can have them using the battery to keep the cab warm. And if you're an outside worker and you can always just go in for some shelter and have a warm place to be without running the engine like in a combustion engine vehicle, I think that's a major advantage. And of course, the bidirectional charging, like the Ford 150 has, a lot of people have suffered from power outages and I think are going to be interested in that feature. So I think there's going to be a market there. It just may not be, the whole truck segment.
Yeah, there is. I've got a friend who just took delivery of a Ford F-150 Lightning and said the feature set is amazing and loves it, loves driving it. However, it's a $100,000 plus vehicle and the issue of the load is an issue. But
for a lot of truck drivers.
Compromising the range when you load it up with stuff is, I think, potentially a showstopper for those that want to pull RV trailers, etc. But, there's a certain segment that just likes a pickup truck for the occasional hauling of stuff and just like the space and so on. And for them, if you're flush and can afford it and can get one, that's the other issue. I think it's going to be a game changer over time.
Well, okay, but I want to say that I really think that these trucks are not the solution to the climate issue. Like, just to give you, so, Peter and I, we saw the EV Hummer last summer. We actually have some photos of us with it. But this is just a ridiculously huge truck. Just to put in perspective, the battery is about 3 times that of a Tesla or other smaller car, like 200 kilowatts. And the car is over 4,000 kilograms, which is about twice what a car would be. And so the efficiency, like in terms of the amount of electricity it takes, it's more than double what an EV car would take to go to the same distance. It's no different than with gasoline, that they're inefficient and they take more gasoline.
I'm not even sure it would be qualified as a light-duty vehicle in some jurisdictions, 4,000 kilograms. I mean, that's like 8,800 pounds.
Yeah, I mean, the Hummer is pretty extreme. But, if we're going to solve our climate issue, it's not only about going electric, in my view. It's got to be using energy more wisely. I mean, you had a book about that.
Yeah.
The End of Energy Obesity.
Yeah.
I don't think this is the year where we've reached it.
I mean, I haven't done the math, how many solar panels you need to charge a 4,000 kilogram vehicle battery, but it's a lot. Merely swapping big vehicles for even bigger vehicles is not a environmentally sound solution.
No. I mean, I think there's a lot of utility to these, but I don't think you're doing it necessarily for the environment. That said, people like their utility when it comes to vehicles, and if it helps get adoption, I just don't know that this is going to enable us to achieve all those net zero goals that everybody wants.
Yeah, but I think we're going to see some momentum behind these electric pickup trucks. I think it's going to sort of influence, in part, sort of the perceptions about electric vehicles as it becomes more mainstream. And so we'll see. We'll see where it goes.
All right, well, theme 6 is Canada's response to the US Inflation Reduction Act and other climate policy that's coming down the pipe from Canada. As we learned in the fall budget, we're going to hopefully get some details early this year in the spring budget about what our version of the IRA is going to look like. And I know there's been a lot of work going on. In fact, over Christmas, there was a consultation for the clean hydrogen tax credit and the labor condition limits. And I expect there'll be other consultations coming very soon this year on other aspects like that manufacturing incentive in Canada.
Right. Well, the Inflation Reduction Act in the United States is so lucrative that it is actually siphoning Canadian dollars into the U.S., whether it's our institutional investment dollars or otherwise in corporate dollars. And that means that Canada is gradually funding the American net zero goals, And so we have to respond if we want to keep the dollars here and if Canada wants to achieve net zero. I think we are going to see the response to the US IRA, but I personally would be skeptical that it's going to be sufficient in its incentives to keep Canadian dollars here.
For all of them anyway, yeah. I mean, I think in some areas it's going to be hard to compete. Like, for example, they provide even better incentives for generators that use domestically produced solar panels, for instance, right? So it'll be tough for Canadian manufacturers to be as in demand as maybe some of the products that are produced in the US. But I think in a lot of areas, we can close the gap significantly. And hopefully these consultations will help highlight what we need to do to achieve that. I know one issue I have is up until now, we've only been talking about investment tax credits, but in the US, they offer in many cases production tax credits. So like a incentive where you get paid for each unit of electricity that you generate over the next 10 years. In many cases, that's the more lucrative option. So it'll be interesting to see if we see like a production tax credit for some of these areas come out eventually. I also think timing is an issue. It's unrealistic to think that in the spring, all the details are there. It takes time to draft legislation to get that through. So I think probably it's more like the end of the year or the fall before we maybe have full certainty on what we're going to get in Canada.
Right.
I did want to note, too, there was obviously a lot of other things going on in policy this year to keep your eyes on. The net zero electricity standard, which I think will help give them more clarity in terms of investment opportunity there. We've got this rules for contract for differences to help firm up carbon pricing and hopefully get some investments going. Clean fuel regs are going to start in the middle of this year. So there's more. There's just a lot of policy, I think, that was uncertain coming into more clarity at the end of the 2022, which hopefully we'll get real final rules on in 2023.
So some people say that the U.S. Inflation Reduction Act is more carrots than sticks, and the Canadian is more sticks than carrots. What do you think?
I think that's true today. However, if we do this right, I think we're going to have some sticks and a bunch of carrots, and I think we are going to see more investment in Canada as a result.
Right. Okay. Yeah. So more carrots. I think we're going into the next theme, which will be interesting in 2023, which is increasing green-on-green competition. That's what I call it. Because to this point, the competition in the energy space has been, let's get off fossil fuels and onto green, doesn't matter what kind of green. I think we're going to start to see discrimination now between green and, in fact, green-on-green competition for the joules of energy that go from primary source to end use. And so this is going to be a shifting paradigm because any company that is championing solutions in the green, clean energy space is now going to have to be conscious about competing for dollars, scarcer dollars, much scarcer dollars from private investment because of where the markets have gone. They're going to have to compete for those scarcer dollars against other green companies.
Yeah, I mean, I think it's a big paradigm shift with the IRA. In the past, except for solar and wind, most green energy really didn't have an economic case. And the solar and wind had some tax incentives in the US that helped, but on its own, it had become economic. However, now we're entering an era that many green carbon systems will, with the tax credits and the things that they have going for them, they do have advantaged economics. And we're going to start to see, like you say, investment go much broader, competing for capital, competing with each other, as opposed to always just competing with your fossil fuel equivalent. And I think it's going to make it a much more unpredictable environment, I guess, in terms of who's going to be the winners and losers and what ultimate technologies are going to be very large 10, 15 years from now.
One of the big problems is that investors, now I'm talking about private capital, not the public IRA type of incentives, but the private capital is still skeptical. Of course, the markets have come off hard in the clean energy space.
Yeah.
They're skeptical about investing in the various green landscape, be it hydrogen, batteries, capacitors, biofuels, you name it. Because as you said, other than wind and solar farms, there isn't a lot that makes money on its own.
Yeah, you definitely need the policy to make the economics work in many of these other areas.
I mean, I think batteries have come of age for vehicles, but generally speaking, all these other areas require subsidization, and there's skepticism. And so there's a bit of a jump ball that's going to be occurring, as I said, this green-on-green competition for the scarcer private dollars, but also the more abundant public incentive in dollars. There's going to be a jump ball that goes on for that as well. And basically, those who can sell their projects the best are the ones that have the highest probability of gaining that capital and putting it to work.
Yeah, I mean, we're entering an era where we've got money going into more early stage emerging areas because the economics work, dependent on policy. But at the same time, I think, it's going to create more uncertainty in terms of those investments. They're just higher risk.
Right.
Yeah.
Okay, what's next?
All right, our next theme is number 8. We're predicting the first final investment decision on carbon capture storage projects in Alberta will occur this year.
Yeah, so the context for this is one of the things holding back CCS investment in Alberta is that the province had not granted rights for storage of carbon, understanding that carbon capturing the CO2 is one thing, but then you have to basically put it underground, put the carbon back in the ground in porosity in the geology, and that there are all sorts of rules and regulations about how to do that had to be established, and that subsurface right to inject the carbon back into the ground requires leasing of those subsurface porosity and geology. All that stuff has been put into place slowly. And so now with that in place, we would expect to see some of the early projects come to fruition, or at least some shovels in the ground, would you say?
Yeah, I mean, for sure. We have some resolution, something like 26 projects have been awarded the rights to do this. But there are other barriers too, like how can you make money doing this? And the concern was that, yes, we have a carbon price, but it's volatile and you're not certain what it's going to look like in a few years. And then there's also some risk that it's not politically stable. We have certain parties in Canada that don't want to support a carbon tax, right? So I think budget had a fix for this, which was this contract for differences. So I think some of the pieces are coming into place. As I said, the clean fuel standard, which is going to be important as well for some of the CCS projects. So I do think we are probably in the position where we'll see 1 to 2 CCS projects, and maybe I'm wrong, maybe there'll be more that get the final investment decision this year, and probably 1 to 2 hydrogen projects, which ultimately do use carbon capture as well.
I think it's important to expand for a moment on the economics of carbon, because we have had speakers in the past on our podcast talking about that, but it's good to refresh because, the point that you made that actually capturing and sequestering carbon is not really a profitable business in a free market sense on its own, that it does require an elevated price of carbon and a guarantee that that price is going to stay elevated or escalated to $170 a ton, for example, by the end of the decade. Because in the absence of that guarantee of price, nobody will invest in these projects.
Yeah, I mean, you're spending a bunch of energy and resources to store this CO2, and if you don't get any money for doing that, you have no reason to do it. You would shut the plant down.
Right. So talk about the contract for differences, which is sort of a buzzword that's emerged over the course of the last 12 months, contract for differences for our audience.
Well, it was mentioned in the fall economic update, and there wasn't really many details given at all. But our understanding is that it would be an office would be set up, and there would be one-off negotiations with each project to kind of figure out what is a floor for carbon price that would be needed to support their project. And these would be private agreements that the government would make on a one-by-one basis. My biggest concern with it is just the time it's going to take to do all of these one-off agreements. And is that going to slow things down because there's only so much capacity to do that? So in theory, it sounds like it could solve the problem, which is create a floor so that the projects have a price that can provide a minimum return on investment. and they can go forward with these investments.
Right.
But this will be very critical to if we're right here about, or if I'm right about these CCS and hydrogen projects moving forward, is some sort of floor on the carbon price.
Right. So the key word is contract. Contract for differences. So the word contract means that the price of carbon is locked in between the government and the project. Because even though the federal government has mandated that the price of carbon will escalate to $170 per ton by the end of this decade, in the event of political change, in other words, change in government through the next election, which is before the end of the decade, that the next government may basically axe that and say, no, it's not going to be 170, or we're going to get rid of it, or whatever. That does not give any comfort to a company that wants to spend billions of dollars on carbon capture and sequestration. A contract that's put into place, however, there is theoretically immutable. In other words, it has to be honored and guarantees that carbon price, rather than a much weaker guarantee that has just been provided by the government. Oh yeah, that the price is going to be 170, but we don't really know what's going to happen.
Yeah, exactly. And because some of this is done in offset markets, there could be a supply and demand changes in the market that bring that price down. So basically, the contract for differences is that whatever the price of carbon is, we will pay the difference, if it's not at a certain floor that's needed to get a minimum return for that project.
Right. So if the minimum return is achievable, say, with $150 a ton, but the actual price is $120, the difference is $30, which the government will backfill to keep that project supported, right?
That's we don't know for sure, but that's kind of the expectation
and
of what it would look like.
There will be one-off contracts with each of these operators that expend the billions of dollars, and that will give them the comfort to spend the money and for investors to come in to the projects, whether they're from within Canada or from outside.
Yeah, and I mean, the advantage of this one-off idea is that every project has a different threshold in terms of what price it needs. So that's more efficient use of the government's money to create a floor that's, unique for each project. However, it's bureaucratic, it takes time, and all these, so that's my biggest concern with it, is how long it's going to take. And, I do feel like one project for CCS, one for hydrogen probably can occur, but I wonder how many if this becomes a bottleneck.
Right. Okay, next.
All right, next. And the final theme is LNG in Canada. So as you all know, Europe needs to fill the void lost by Russian gas. They did take about 11 to 12 BCF per day from Russia into Europe in 2020 and 2021. To put that in perspective, Canada produces about 18 BCF per day today. So, it's a substantial amount of gas that needs to be supplied by others into the future. And we've seen a number of deals go forward. For example, deals forged between Europe and Qatar. Just January 3rd, we heard that Sempra has made a deal with Germany from their Port Arthur LNG project. We know the US is going to probably have more announcements this year. What's the outlook for Canada?
Well, I think the outlook for Canada is that the discussion about LNG will die down, in my opinion. I don't think the East Coast, like the Saguenay projects, are going to go ahead. I think maybe LNG Canada on the West Coast at some point may announce another train, but that's about it. There's a few other projects that are in the works. But generally speaking, again, it's going to be very hard to compete against what's going on in the United States. The Gulf Coast LNG projects, I think, are going to gather further momentum, as you just said. And that Canadian gas, which is hooked up to a continental grid, will just make its way down to those LNG terminals in the United States and transit from there to foreign markets. So again, we rely on the U.S. as our agent to take our gas, liquefy it, and sell it to others rather than do it ourselves.
Yeah, sadly, I do agree with you. And for those that would like to learn more about that topic, remember we had Cheniere, a major exporter of LNG out of the Gulf Coast, and ARC Resources, who had made a supply agreement with Cheniere to provide Canadian gas to that facility. I think that's probably going to be the bulk of how we participate in the global LNG markets. Yes, LNG Canada, let's hope we get second phase. And there is a number of other smaller projects moving forward. I think those will happen. But I think the very large projects are probably going to be going to the U.S. So it's a huge lost opportunity for Canada. Just as a reminder, that LNG Canada project alone was reported to be about a $40 billion total investment into our economy. people creating jobs, building the project, operating the project. We're giving that up by not participating.
Right. The other dynamic that I am sure we are going to spend time on in 2023 podcasts are things like the emission reduction cap, the targets for 2030, the upstream requirement to reduce emissions by 40+% by 2030, even more in 2035. That comes at a time when we are in need to grow the production to fulfill the pipeline exports.
Right, and to continue to supply
exports.
into the U.S. Hey, I did want to mention another important thing for 2023. Hopefully this time next year it'll be a reality, but the Trans Mountain pipeline which will be moving oil this time next year to Burnaby and shipping it off our West Coast. That should really help our crude oil price differentials that have really come under pressure recently.
Right.
But the plan right now is, as of the latest update, that it would occur in the latter part of the fourth quarter of 2023 that pipe would be operating. So let's hope that occurs this year as well.
It seems like it's on the horizon. I mean, it's been such a long saga. Maybe we'll wait until second or third quarter before we talk about it because it's just always takes twists and turns.
Well, as we get closer to that very important date, let's talk about having a podcast. I know we've had Ian Anderson from Trans Mountain on a couple of times, but it would be great to have Don Farrell, who's now leading the charge for the Trans Mountain, as we get closer to the startup of that very important piece of infrastructure.
Well, we've covered a lot of ground, Jackie, on this list. I think there's 9 themes that we covered. There's going to be plenty more, I'm sure, as we record more podcasts into 2023. At this point, we'd like to again thank all of our listeners around the world. We have many in many jurisdictions, stretching from South America to the Middle East, all the way into Southeast Asia. That we wish all of you a very happy new year and a prosperous and healthy one as well.
Yes, and thanks for following. If you enjoyed this podcast, please rate us on the app that you listen to and tell someone else about us.
For more ideas and insights, visit arcenergyinstitute.com.